Have you ever wondered if the big banks and top institutions engage in index investing? And if they do, what funds do they purchase? I'm Justin from Tater, and today we are going to reveal the exact ETFs preferred by Wealthsimple, Questrade, and RBC Direct Investing. After that, we'll discuss our system, which helps Canadians easily invest in these same portfolios themselves independently, thus saving on all of the fees they would otherwise be paying for these robo-advisor services. And this is really huge because you've probably seen those Questrade commercials that talk about the massive savings over the long term you can experience just by eliminating mutual fund fees, while robo-advisors charge fees too. They're not as large as mutual funds, but you can still experience a six-figure gain in your portfolio over the long term just by eliminating those fees. More on that coming up, but first, the ETFs favored by Canada's top institutions. So we are just going to jump right in and focus on equities, otherwise known as stocks, for the majority of this video. And if you would like to learn more about ETFs and how they work, we will post a video really soon and you will be able to find a link here. For a deeper dive into some of the ETFs we will look at today, you can check out our Robo Review videos where we review the various robo-advisor offerings in Canada. So be sure to check those out. We will leave links in the description and cards as we go. But if you have been fortunate enough to bear witness to those insanely informative and entertaining videos already, this video is still a must-watch because I provide even further details and insights on the ETFs, including pros, cons, comparison, and analysis. If that's not enough, this video contains some insanely hilarious and entertaining moments, and it's almost as exciting as watching your bonds grow. Okay then, let's hop right into it, and I promise you these Canadian equity ETFs are much more impressive than my comedic talent. The big institutions we are going to be cherry picking from today are Questrade, Wealthsimple, and last but not least, the Royal Bank of Canada. Questrade's most favorite Canadian ETF is ZCN, Wealthsimple's bestie is HXT, and RBC's ringer is XIC. Justin, these letters aren't really telling me anything. I know, because these are the ticker symbols. So, Questrade's offering is from BMO, Wealthsimple's is from Global X, no relation to Elon, and Royal Bank's is from, not Royal Bank, but iShares. So what? Okay, well, ZCN tracks the S&P/TSX capped composite index, and we explain what that is in our video on ETFs. HXT just tracks the S&P/TSX 60, which we'll discuss momentarily, and XIC also tracks, like ZCN, the S&P/TSX capped composite index. What a copycat. Management expense ratio, which means cost, which means if you don't know that, watch our ETF video. ZCN 0.06, HXT a little bit more, 0.08, and XIC dreadfully unoriginal 0.06. So a quick note on dividends. ZCN and XIC pay out somewhere around 3% per year. This is called the annualized distribution yield. HXT, in contrast, reinvests dividends and doesn't pay them out, offering no significant distribution yield, but it is more tax efficient, especially in a taxable account for higher income individuals, as it defers taxes until the shares are sold. However, in tax sheltered accounts like RRSP or TFSA, HXT provides no additional advantage unless you have an aversion to cash showing up in your account. So it's really interesting. The TSX 60 actually has shown less volatility and better returns. And the data is not really long term, and we would like to see a much longer term picture. The TSX 60 was introduced in 98, and the S&P/TSX composite index has only been tracked in its current form since the 1970s. As a result, we can really only analyze the last 20 or 25 years to compare the two. Most index investing gurus would say you're better off investing in the broader index than the concentrated TSX 60. And as every fund in Canada has to state, past performance is not indicative of future returns. I will let viewers make their own decision. Okay, enough about the Canadian ETFs. Now let's have a look at the US options. The Canadian institutions we've been fawning over need no introduction because, well, I've already introduced them, but I have yet to introduce their most favoritist US ETFs. So let's get going. Questrade is SPTM, Wealthsimple loves HXS, and Royal Bank is sitting in the tree with XUS. The latter two ETFs are from the same providers, Global X and iShares, but Questrade said, sorry BMO, it's not you, it's me. We would like to see other providers, and in this case, they are going out with State Street. And if you haven't heard of them, they have actually been around since 1792, and they introduced the very first ETF ever in 1993. SPTM tracks the S&P 1500 Composite Index, so it has broader exposure to mid and small cap companies, whereas HXS and XUS are not interested in the small time, and they just track the S&P 500, which provides exposure to primarily large cap companies. Talk about MER. What's that, SPTM? You want to talk about MER? Well, that's probably because you have by far the lowest MER at 0.03%, but that is primarily due to the fact that you trade in US dollars. HXS and XUS come in significantly higher as they trade in Canadian dollars, which is more convenient for us Canucks, but more expensive. Speaking of expensive, have you seen the trading expense ratio on HXS? 0.3%? What? The other ETFs we've discussed so far have negligible TERs, i.e. zero. HXS has a way higher TER, partially due to the fact that it engages in index swaps rather than holding the underlying companies in the index. But I won't bore you further on swaps. That is beyond the scope of this video. Let's just say that they do it so that they don't have to pay out dividends. They reinvest those dividends, making it advantageous to us Canadians because we don't have to pay the withholding tax on the US dividends. Side note, because SPTM is denominated in US dollars, you would also avoid paying these withholding taxes if held in your RRSP. So do we invest in the more compressed S&P 500? That is what a lot of index investors do. Or you can invest in the broader market, get a total stock market ETF, which a lot of investors do that as well. You really can't go wrong with either. The other item to consider when purchasing a US equity ETF is, do I purchase one in Canadian dollars, which is more simple, or do I purchase one in US dollars? More complex. SPTM is in US dollars and has a significantly lower MER, which you generally see across the board when you get a US dollar equity index ETF. They are generally significantly cheaper when compared to the Canadian dollar version. And you save money on withholding taxes when you hold them in your RRSP. So another thing to consider is, do you want to pay the conversion fee, which is somewhere around 2% that Questrade or your broker will charge, or do you want to execute Norbert's Gambit to get a much cheaper exchange rate? I opt for the latter, and if you are not going to execute Norbert's Gambit, if you're not comfortable with it, then you are better off with a Canadian dollar US equity index ETF. If you are interested in saving money on the MER and going with the US version, then check out our videos on Norbert's Gambit. Links will be in the description, and we'll provide some cards somewhere. Okay, that's it for the US ETFs, and make sure you stick around to the end because we are going to show you our program to invest in any of these robo-advisor portfolios on your own and save on all of the fees, which makes a gigantic difference in your portfolio over the long term, so stick around for that. Next, we are going to focus on the international developed market ETFs, and these institutions provide some really good options. Only two ETFs in this case, actually, because Questrade and RBC both agree XEF is the best international developed markets ETF. However, Wealthsimple disagrees, and they are going with HXDM. This is indeed a heated battle, folks, between two heavyweight contenders. XEF hails from iShares and XDM Global X. They can find some common ground here, however, because they both track EFI indexes. EFI is not only fun to say, it also stands for Europe, Australasia, and the Far East. Australasia actually refers to a region that includes Australia, New Zealand, Papua New Guinea, and neighboring islands in the Pacific Ocean, if you didn't know already. The action is waning here, folks, as we have some more common ground. Both ETFs have an MER of 0.22%. However, that star, which I thought looked cooler than an asterisk, means there are some differences here. Oh, the action is intensifying as the audience is getting dizzy here. Oh, that's actually just deja vu. The difference in cost is that, again, the Global X offering HXDM has a significantly high TER, and that is because of its swap-based structure, which allows for tax efficiency by avoiding direct distributions or dividends. This means that your costs are a little bit more for the fund, but you will save on the withholding taxes on the dividends. Time for the boredom alarm. Is everybody awake? Okay, that's it for the developed market. Next, we are going to look at an even more exciting one, emerging markets, which offers the potential for even more growth because it's emerging, but more volatility. Let's go. Questrade's at it with the four-letter words again. They've got SPEM from State Street right back at you, says Wealthsimple with EEMV, and Royal Bank just says XEC. The latter two are from iShares, but they are very different, and we'll cover that momentarily. SPEM tracks the S&P Emerging BMI Index. EEMV actually tracks a minimum volatility index, so not a market cap weighted one. And then XEC tracks the MSCI Emerging Markets Investable Market Index. Questrade's ETF rocking another real good MER, 0.07%. Again, primarily because this ETF is denominated in US dollars. Wealthsimple may like their minimum volatility ETF, but they do not like minimum MERs apparently. There's a 0.25%, and then XEC says, I see your 0.25%, and I raise you 2 basis points to 0.27. So a super quick and informative summary here. SPEM is in US dollars. It's a traditional market cap weighted equity index ETF. EEMV, on the other hand, denominated in Canadian dollars, and it tracks a minimum volatility index. Finally, XEC, very similar to SPEM, but it is in Canadian dollars for your convenience. Up next is the main event of the video, because we are going to show you how to easily build and manage one of these robo-advisor portfolios on your own and save a ton on fees. If you are hoping to see some bond ETFs in this video, just let me know in the comments and you'll see another video coming out soon focusing on them. So more about our system. It saves tons on fees, you can do it with ease, and it takes very little time. In a lot of cases, it only takes a couple of hours per year to manage these portfolios on your own, to invest a little bit more money. We make that super easy. We also make it really easy to rebalance the portfolio, and you only really need to do that once a year. So building this on your own, really easy and really, really worth it. So let's show you how to do it. Really quick, just want to show the amount of money investors could save simply by using our program and eliminating the fees charged by robo-advisors. It is really remarkable. As you can see across the top, this is the initial investment amount, and then along the side, the investment horizon is the number of years invested. So over 20 and 30 years, you can see the different amounts investors could expect to save simply by eliminating the fees from RBC. So as you can see here, even if you only have $50,000 to start, after 30 years, you could expect a portfolio improvement of over $126,000 just by eliminating these fees. Let's hop over to our Tater Portfolio Manager, and we will really quickly show you how to easily build and manage one of these portfolios to save on all of the fees, and we will open up the RBC Growth Portfolio. But as you can see, we've loaded in all of these portfolios from Wealthsimple, Modern Advisor, Questrade, CI Direct, and RBC, so you can build any of these portfolios on your own using our spreadsheet here. We'll click on the tab here to open up the RBC Growth Portfolio, and all you have to do is enter the initial amount you have to invest. So let's say 50,000. And then you simply purchase the number of shares shown in the shares to buy column. And when you do that, you fill in the table below after you purchase the shares from your brokerage, which we are happy to help with as well. And then you can see the remaining uninvested cash is just over the 2% called out for in this portfolio. In the future, when you have additional cash to invest, you would enter it into this cell. For this example, let's say we have $5,000. We'll just enter that, and then the far right column will show you the number of shares you need to buy in this situation. And then this column also shows you the number of shares to buy or sell to bring your portfolio back into balance in the future when share prices fluctuate. And as mentioned before, investors really only need to rebalance one time per year, so very little time is involved in managing these portfolios, and this time is very valuable. It can be worth thousands of dollars per hour just based on the long-term savings. Our Tater Portfolio Manager spreadsheet is free for a limited time for our YouTube subscribers, so let us know if you are interested. We also provide instructional videos and help along the way via email. Before you do anything else, make sure you have subscribed and rung the bell, wherever it is, to make sure you don't miss out on our next video. If you like this one, then you can click like too. We would appreciate that. And if you would like that spreadsheet that we showed in this video, our Tater Portfolio Manager, to help you build this or one of the other portfolios on your own, just let us know. Leave us a comment, and we will see you next time.